Welcome to the REI Diamond Interview, your source for real estate investment jewels of wisdom with Dan Breslin.
Welcome to the REI Diamond Show, mid-month market update from March 2016. I'm here with expert economist and wealth advisor Paul Sloate, also founder of Green Drake Advisors in Wayne, Pennsylvania. Each month, Paul comes on the show and does this mid-month market update to enlighten us real estate investors to the macroeconomic forces at work in the global economy and what those forces are expected to do to the local real estate investment markets in the short and long term. Paul, welcome to the show.
Well, thanks, Dan. I'm glad to be back.
All right. So what's going on in the market here that we should know about, Paul?
Well, we'll talk about just a couple of things going on a more macro basis, and then I got a lot of little micro things to discuss this month. So one thing we should think about that's going on is that this global economy, which kind of slowed down because of this collapse in commodity prices, that's kind of been playing through. And the drag on both the U.S. and the global economy should start to fade. And we're already seeing early indications of that from places like the National Association of Purchasing Managers and other places where the industrial data is starting to get less worse, and which means at some point it's going to start to get better. So that's one thing that people should keep in mind, and it's probable that the U.S. economy is going to accelerate in the second half of the year. And another thing that investors should keep in mind in real estate is that this collapse in commodity prices and the rise in dollar has really masked a much higher rate of inflation than is being stated. So in the goods/commodities area, we've had negative pricing. But in the services side of the economy, the pricing and inflation has been running between 2.5% and 3%. So what's likely to happen once commodity prices stop going down and the dollar stops going up, which we're probably very close to happening, is that the underlying inflation rate's going to start to show in some of the data, and that's likely going to give a little boost to interest rates. And in fact, interest rates have already been going up except for government securities. And I'll give you an example of what's going on in the real property market. So I was recently talking to a number of the big REIT investors who are out there buying properties. And the one thing they have been telling me, for example, in, some of the office markets, what they're seeing is that their borrowing rates now are up around 70 to 75 basis points from where they were recently. And the cap rates have started going up. And we have been talking about the fact that cap rates seemed awfully low when viewed in a long-term perspective. So we may be seeing the leading edge of a turn in cap rates where they're going to be rising for the rest of this recovery and into whatever kind of recession we're going to have later this decade. So that's just something to keep in mind. And another thing to keep in mind for those who are focused in an area like Washington, D.C. is that, well, we're going to have a new presidential administration one way or another this year, and all those people are going to need to rent space. And so if you've got a bunch of Republicans coming in, you're going to have pretty good demand in the D.C. area for office space down there. And it's just part of the whole presidential cycle. So we thought we'd talk about that. And there's one other data point which I was looking at recently in terms of office that people should keep in mind when it comes to office. If we go back to, not that far, but let's say 2007, the square footage occupied per employee was almost 135 square feet per employee. In 2015, which is the latest year for which we have some data, that number is now less than 125 square feet per employee. So what's happened is that the demand for space, assuming that we had the same number of people working in offices is down around 6-7% because of this continued decline in square footage per employee. So even if you get demographic growth, it seems to be offset almost completely by this drop in occupied square foot per employee. And that also means with a bunch of office buildings coming on later this decade, it might start putting pressure on the office area. So that's just something for our investors to think about in terms of doing investment in office buildings. Now, of course, there are exceptions in particular markets because, as we know, all real estate is local, but that's something that investors just should keep in mind. And I'd like to turn to the hotel industry, which has had a great run. The hotel industry recovery is now a little over 5 years old, almost 5.5 years old. Typically, these recoveries last 5 to 8 years. So you're already past the low end of how long these recoveries last. Now, there's a couple of other interesting statistics about the lodging industry our listeners should keep in mind. The lodging industry seasonally adjusted occupancy rate hit a high late last year, sort of mid to late last year, of about 68%. And that would put it back where the high was in the 1990s. And at the same time, real ADRs, that's average daily rates for the hotels, also got back to peak levels similar to the peak in the early 2000s before the recession and in the mid-2000s before that recession. So we really should think about performance of hotel properties as being at sort of peakish type levels. That we should keep that in mind because the supply growth of hotel rooms is rising from about 64,000 rooms in 2014 to about 114,000 rooms under construction to be delivered in 2017. Or we're almost doubling the supply, so we'll be adding about 2.1% to supply here in the United States. And that is likely to start to put pressure on hotel occupancies and hotel ADRs. So that's something to keep in mind. And in fact, ADR has slowed. According to Smith Travel Research, hotel industry-wide RevPAR increased about 2.5% so far this year, but the latest 4-week period, it's up only 2%. So that is for the U.S. We should note that there are big variations, and certain markets such as San Francisco and L.A. are having continued strong results, but other markets such as New York are struggling because a place like New York had a 7% RevPAR decrease. And New York's having a lot of trouble because that was against almost a 10% decrease a year ago. So those are just some things for our listeners to keep in mind. As you know, Dan, we've been talking about what's going on in the multifamily/apartment area for some time, and we think that things are as good as they get. And as I noted earlier on the show, cap rates have started to go up. So that's one thing. And the other thing that we know, based on what a number of the larger public entities have discussed, is that actual rental growth, same-store rental growth, has begun to slow. So it looks like it's going to be down 0.5% to a percentage point in terms of the growth rate in 2016, and probably will slow more in 2017 as the over 400,000 units that are under construction are brought to market. And we would note that this is the highest level of rental apartment starts since around 1987. Now, I remember the 80s, and the 80s were a boom for apartments because the baby boomers were coming into that business of renting apartments. because they were moving into the workforce. And what we've had this decade is the millennials have been moving into the workforce. And then what happened is you had the 90s where all the baby boomers bought houses. And it appears that that's what we're going to have with the millennials. And I'll talk about some data about that in a few minutes. But before we get to that, when we look at the apartment rental market, the amount of additional apartment units that we estimate are needed annually to meet demand growth is somewhere around 250 to 300,000. So let's say 275,000 units. And part of that is to meet demand for new units, demand growth, and part of that is to meet what we estimate at about 150,000 units that become outmoded and need to be basically torn down or rehab. So you're going to have 270,000 units, but we're building like 400,000, so we're building an extra, let's say, 125,000 units per year right now for the rental market. And starting as these come on in early 2017 and late 2017, they should begin to put more pressure on the apartment market, probably just in time for a late decade recession. So when we look at the rental market, we are increasingly cautious on apartment properties, especially given occupancies, given that rental rates relative to incomes are as high as they were back in the 80s before they regressed to the mean. And also, there's one other interesting fact. It is now, and has been for a while, and I'll talk about what this is having on impact on some other areas, but it is cheaper to buy versus rent an apartment. And so let's say you're a family and you have one kid and you have a two-bedroom apartment. Nationally, the average rental rate for a two-bedroom apartment is about $1,200 a month. And now remember, there's wide variations, whether we're in Philadelphia or we're in Harrisburg or we're in New York, in Chicago. All these cities are going to have different rates. But if we were to look at what the average mortgage payment is for the first-time home buyer, assuming that they take out mortgage insurance and assuming the cost of homeowners insurance, so we look at the total payment, and we assume they're in the 25% tax bracket, which a lot of new homeowners are, and that only the mortgage payment and the interest is tax deductible. Now, we all know that the mortgage insurance is tax deductible. There's a disallowance if you make too much money. So for our purposes, we're just assuming that that mortgage insurance is not tax deductible. But if we just assume that the mortgage payment and interest is tax deductible, it's actually several percentage points cheaper after tax for that couple with a kid to buy a house and make a mortgage payment than it is to rent an apartment. And that's excluding the fact that home prices go up and that their equity goes up. So over time, they're building actual capital. So we think there's going to be more and more impetus for people who can come up with a down payment to buy a starter house. And in fact, if we look at the way the housing marketplace is bifurcating right now, the more expensive half of the market has slowed and the bottom half of the market has accelerated, which is an indication that this is indeed what is happening. People are leaving apartments and they're going to buy a house. And we have some recent data on millennials that show that the percentage of millennials is continuing to move towards home ownership. And not only are they moving towards home ownership, they're moving towards home ownership in the traditional suburban places because they're settling down and having kids and worried about the schools, and a lot of inner cities and other places where they've been renting can't meet their needs as they have a growing family. And we'll run one other statistic that we know to be true for most of the major cities. Young families with one kid have a 50% chance of staying as renters, but almost to 100%. Once they have 2 kids, they move out of the city and they move into the suburbs because they can't afford usually to send 2 kids to private school, which is what they would typically need to do. That is sort of my update for this month as what we see going on and what the data is telling us. And I hope that's of use to our listeners this month, Dan.
Wow, I got a couple pages of notes, Paul. I really appreciate you coming on and bringing this perspective. It confirms, some of the business decisions I know I've made personally, and we're getting a ton of great feedback from the listeners as well, Paul. So I really appreciate your time and appreciate you coming on the show.
Well, thank you, Dan, and I look forward to next month.
Do you want to share your contact information one more time just in case anybody would like to get a hold of you, Paul?
Sure. It's Paul Sloate. And my firm is Green Drake Advisors, and we are located in Wayne, Pennsylvania. And the best way to get a hold of us is to give us a ring at 610-687-7766 and ask for me.
Thanks again, Paul. Thank you, and thank you all for listening to the REI Diamond Show. As always, you can check out past REI Diamond Show episodes at www.reidiamonds.com. Thanks again for listening. Dan Breslin here. I'll catch you next time. And remember, here at the REI Diamond Show, we are dedicated to increasing and protecting your net worth.
Thanks for listening to the REI Diamond Interview. To receive the REI Diamonds newsletter and interview monthly, sign up now at www.reidiamonds.com.